Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're going to be talking about probably my favorite investor and one of my favorite companies actually that's ever been built over a long period of time, and that is Berkshire Hathaway. Berkshire Hathaway has been probably the investment of the century if you had bought it anywhere near the time when Warren Buffett was first acquiring shares, and it's turned into a global behemoth. So Warren Buffett first bought his shares in Berkshire Hathaway for around $7.50, and he actually intended to sell those. So the story goes that he negotiated a price privately with someone that wanted to purchase Warren Buffett's holdings from him, and the price they agreed on and shook hands on was $11.50, and the offer actually ended up coming back after that meeting at $11.37.5. So the guy tried to sort of cheat Warren Buffett out of an eighth of a dollar per share. That made him very, very mad, and he basically turned around and just bought as many shares as he could, enough to get control of the company, get on the board, fire the current management, and then take the whole thing over himself. So it was a very uncharacteristic kind of emotional move for Warren Buffett. Probably the worst investment he ever made, as he put it. But he's turned the business around. It's very, very different from where it first started. And those same shares that were acquired for anywhere between $7 and say $12 are now worth around $280,000. So ridiculous gains. Very, very different business from when it was just a textile mill when it was first acquired. But one of the big questions for Berkshire Hathaway shareholders today and people looking into the company in the first place is, what happens after Warren Buffett is gone? Unfortunately, the guy is currently 89 years old. He has been old for a very long time now, and unfortunately he's not going to be with us forever, and I think it is an important topic to kind of talk through. So I want to give you my thoughts on where I think Berkshire Hathaway is going after Warren is no longer with the company, and same with Charlie Munger for that matter as well. So let's get into the video. So the first thing you have to understand about Berkshire Hathaway in general is that the previous gains that have been made, there's simply no way that those same gains will happen in the future, even if Warren Buffett lived to 150 years old. And the reason for that is essentially the law of large numbers. So back when Buffett was working with millions of dollars rather than hundreds of billions of dollars to invest, he was able to have a much larger universe of potential investments, and that meant that he could find more attractive opportunities and put a large percentage of his money to work in relatively small companies, often much more likely to be mispriced than large, very closely followed companies. So for example, back in the early days he was following a very Ben Graham quantitative kind of approach to investing, where he was looking really purely at a lot of balance sheet numbers, and he was acquiring companies in several situations. He was buying shares in that company for less than the amount of cash the company had in the bank. So very, very cheap businesses, and him and Ben Graham even would actually go to company meetings and try to get a seat on the board and be a little bit more active in terms of trying to adjust the management of those companies to try and get them to pay all this excess cash out to shareholders. So those were the types of investments that were available to them back in the day. Now that's just simply not possible with the scale that they're working with, and it's very unlikely that massive, really closely followed companies like Apple, for example, are ever going to trade at less than cash. That just doesn't happen when you've got like tens of analysts following the company very closely. So that's one of the big reasons why Berkshire will not do as well in the future as it has done in the past. That doesn't mean it's not going to be a great investment over the next several decades. It's just not going to be as spectacular as it has been in the past. So that's the first thing I just want to get out of the way in general. Even if Buffett was around, it just would not do as well as it has done in the past. So now let's get into Berkshire Hathaway's actual business. So I think it's important to understand what Warren Buffett actually does at Berkshire Hathaway, and then that gives you a good kind of picture of how it might look after Warren Buffett is gone. So Berkshire Hathaway sort of has two sides to their business. So they have a side where they wholly own a lot of companies. So they own 100% of the shares own the whole thing. Those are the likes of Dairy Queen, Borsheim's, Fruit of the Loom, Geico, all these very famous companies that many of you will have heard of that Buffett has acquired over the years. Those are fully owned companies of Berkshire Hathaway, and Warren Buffett essentially has zero to do with the day-to-day management of those companies. So each of those businesses have their own managers. They are largely left to their own devices to just run their businesses, and when they produce excess cash, they send that money to Omaha, and that's where kind of Warren Buffett's job comes in. So Warren Buffett's job is and has been for a long time allocating capital, as he puts it. So he's acquired these businesses over a long period of time. Those businesses make a bucket load of cash, which gets sent to Warren Buffett. And Warren Buffett essentially has the job of redistributing that cash into buying new businesses, whether they be, again, companies that he buys the whole thing, or whether they be companies that are trading publicly as stocks, and he's buying small percentages of ownership in those companies. So in my personal opinion, just looking purely at the first few things that I've said there, the operating businesses that Berkshire owns are not going to change when Warren Buffett is gone. Geico is still going to be a fantastic business. All of the insurance operations are still going to be doing just as well as if Warren is not there. And he's tried to set it up in a way where he doesn't have the managers of those businesses spending a bunch of their time trying to just report to the board on kind of what's happening. He wants those businesses to perform as well as possible, and a lot of times that just means leaving them to sort of do their thing. So I really don't think anything is going to change with the operating businesses, because Warren just frankly has nothing to do with a lot of them. But what will change is the redistribution of profits and allocating capital to new investments. So in my personal opinion, on the operating business side, I think the top candidates to sort of take over Warren Buffett's sort of oversight role, I suppose, is probably Greg Abel. So Greg Abel, for a long time, has run Berkshire Hathaway Energy, and in my mind, he's the obvious choice at this stage to take over at least that side of the business. He actually already has moved into a role of overseeing a lot of non-insurance businesses. So that's probably what's likely to happen on that side of things. On the investment side, so the obvious choice here is going to be Todd Combs and Ted Wexler, and they have been managing money for Berkshire Hathaway for probably close to a decade now. Nowhere near the scale that Warren Buffett has been doing it, but they're the obvious choice to move into being the head honchos in that sort of part of the business. And I think this is really the area that the business will not do as well as Warren Buffett has done. I think Ted and Todd are phenomenal investors, and they have great track records. We haven't had a lot of updates on that since they've been at Berkshire Hathaway, but pre-Berkshire Hathaway, great returns from what I've seen. And I think they're very well tempered and in a great position to continue doing a good job for Berkshire Hathaway once they move into working with larger sums. Now, the other thing we have to understand with the redistribution of capital for Berkshire Hathaway is that the way Warren Buffett sets up his investment portfolio is a lot like he buys private businesses. So he sets them up in a way in which he intends to basically hold those companies for a long period of time. So when Warren Buffett does move on from Berkshire Hathaway and Ted and Todd, or whoever it is, takes over the investment operations of Berkshire, I don't see there being a lot of immediate changes. So I don't expect Ted and Todd to come in and sell the long held, Coca-Cola stake and sell Apple and make all these various changes kind of straight away. I think largely the portfolio is going to be pretty unchanged for probably quite a significant period of time. And what we'll instead see is additions to that portfolio. So Berkshire's in a great position to where when they want to make a new investment, they don't have to sell existing stocks to put money into those new investments. They've got a constant stream of cash coming in from their operating businesses and also from dividends, to a lesser extent from their publicly held companies. So that's largely what I think is going to happen with Berkshire. I think the business, all of the underlying businesses of Berkshire, as on average, are phenomenal and will continue to produce a lot of cash for a long period of time. So I don't see Berkshire Hathaway doing a lot worse, frankly, when Warren is gone. The investment track record will certainly not be as good as it has been in the future, as it has been in the past, but I think it would be that way whether Warren was there or not. And of course, it would probably be better if Warren did live to 150, but I really don't think it'll be that much worse off with Ted and Todd or or whoever it ends up being at the helm. So the final part of today's video, now that we've got the actual operations kind of side of Berkshire out of the way, is I want to talk about intrinsic value. So that's what a lot of you always like to see on this channel, I think. So let's get into my thoughts on calculating the intrinsic value for Berkshire Hathaway. So with getting to intrinsic value for Berkshire, this one's a little bit unique because Warren Buffett has actually for a long time given us a bit of a cheat code on this. So I haven't gone ahead and used a discounted cash flow or the margin of safety method from Philtown or anything like that to actually get to an intrinsic value estimate for Berkshire. For a long time, Warren Buffett has used book value as a proxy for the intrinsic value of Berkshire Hathaway. And that book value multiple that he's estimated, and he's been writing about this for a long time through his annual reports, has grown over time. So he, for a long time, was authorized by the board of Berkshire Hathaway to buy back shares at anything below 1.2 times book value. That doesn't mean he had to buy it below that level, but that's where he had the ability to do so. And that suggests to me that anywhere below 1.2 times book value is definitely below intrinsic value. So it's not necessarily a huge discount, and 1.2 is not necessarily equal to intrinsic value, but I think 1.2 is at least a modest discount. Now, in more recent years, Warren Buffett has tried to move away from a book value multiple, just simply because it's become less representative of what Berkshire does now. So they've gotten more into operating businesses that produce high returns on capital versus asset heavy businesses where book value might be a better proxy. And there are businesses that Berkshire has owned for a long time that are still sort of on the books at their purchase price, and their purchase price maybe 1/5, for example, of what that business is actually at now. So that's the reason he doesn't use book value itself. He uses a slight premium to book value. Now, all that info said, and all the reading that I've done of Buffett over the years, what that leads me to give you an estimate of is probably somewhere around 1.3 times book value is what I would put as a conservative estimate of intrinsic value. I think it could well be a lot higher. I don't think it's a lot lower than 1.3 times book value. So that's about my sort of conservative estimate. So don't take that to the bank as, anytime Berkshire's below 1.3 times, which it actually is at the moment, you should be buying it heavily or anything like that. Don't take that as advice, but that's kind of the proxy I use. And if you look at the Berkshire Hathaway book value multiple now, it's right about 1.1 times book value. So it is, in my opinion, at least undervalued at the moment. And it is actually at probably the lowest book value multiple that it has been in several years. I'll try and put up a chart here just to show you what I mean by that. And I think Warren getting to his twilight years is potentially a reason for that. I think it provides a great opportunity to buy back shares at a discount for Berkshire Hathaway. The trouble historically with Berkshire Hathaway going out and wanting to buy back shares is whenever Berkshire Hathaway is cheap, there's usually a bunch of other companies that happen to be cheap at the same time. So we've never seen Buffett necessarily put as much money to work on share buybacks as he would have liked. So that's a bit of an overview of Berkshire and what I think it's probably going to look like in the future. So I hope you did enjoy the video and I hope it was valuable. If you did, hit like, hit subscribe. You can watch some older videos over there. Hit subscribe over there, and I will see you in the next one. Cheers.